Alphabet. We're looking at an absolute monster of a move right now, and today's explainer is diving straight into the crosscurrents. We've got our hands on a Vanguard neural intelligence briefing, and we're executing a full chronological assessment protocol on Google GOOGL. We are right on the edge of a critical catalyst, the Google I/O conference, and the stakes literally could not be higher. If you've been trying to make sense of the AI hype, the macroeconomic reality, and what the billion-dollar institutional whales are actually doing behind the scenes, well, you're in the right place. Let's unpack the data.
Right out of the gate, we have to talk about the price action because it's been nothing short of breathtaking. We've witnessed this violent parabolic ascent, ripping all the way from the 270 range just a couple of months ago to nearly 400. And as of this briefing on May 18th, the price is sitting exactly at $396.78. But here's the psychology you need to understand. While retail investors are staring up at that peak, desperately hoping to ride the momentum, institutional analysts are looking down. They're calculating the floor. This asset has completely transitioned out of consolidation and into hyper-aggressive expansion. So who's actually driving this run?
Well, that brings us to one of the most shocking metrics in this entire briefing. We are seeing an extreme divergence in institutional valuation models. I mean, a massive tug of war. On one side, you have the ultimate value titans over at Berkshire Hathaway. Greg Abel has aggressively tripled their stake in Alphabet. They're holding nearly 58 million shares now, making it a top 5 position. But then, right across the aisle, you've got Bill Ackman completely liquidating 95% of his position. The smart money is completely split. Ackman is clearly signaling that the short-term risk to reward is completely broken at these all-time highs. But Berkshire? Look, they don't buy bubbles. They buy impenetrable moats. So what exactly is Berkshire seeing that Ackman isn't?
It all comes down to one singular narrative: AI leadership. And the Vanguard neural analyst hits the nail right on the head here. They wrote, Alphabet is building the physical infrastructure that will power the next 20 years of the internet. Think about that for a second. This isn't just about software tweaks anymore. It is about total, foundational ecosystem dominance. From search to Android to Chrome, Alphabet isn't just trying to participate in the AI supercycle. They're actively trying to become the primary toll booth for it. But as you might guess, winning an arms race of this scale, it is incredibly expensive. And that brings us to the fundamental burn rate. Let's look at the bear case here, because the numbers from Q1 2025 to Q1 2026 are stark. Capital expenditure has literally doubled. They jumped from $17.2 billion to a staggering $35.67 billion in a single year, just aggressively building out data centers and AI accelerators. But look at the fallout. Their free cash flow has plunged all the way down to $10.12 billion. The bears are looking at this and arguing that Alphabet is essentially burning the furniture to keep the lights on in this AI race. I mean, if you double your spending and slash your cash flow by more than half, you are exposing yourself to some massive short-term strain. But we have to keep that CapEx burn in perspective, right? The balance sheet tells a much bigger story. Look at the liquidity. Alphabet is sitting on a $126.8 billion cash cushion. Sure, their long-term debt has ticked up to just over $90 billion to fund this massive infrastructure rollout, but when you have nearly $127 billion in cash and short-term investments, you aren't straining, you're deploying your arsenal. They have the absolute financial fortress required to weather this free cash flow dip. That is, of course, assuming the AI harvest actually materializes down the road.
But what if that harvest is a mirage? The briefing highlights this fascinating macroeconomic risk identified by the Kiplinger letter, and they call it the AI GDP paradox. Here's the core idea. All this massive hyperscaler spending on AI chips and servers, it's currently operating as an import. And in macroeconomics, imports actually subtract from national GDP. So there is a very real, very intense debate right now. Does this historic infrastructure spend actually translate into real economic growth and productivity, or is it just a massive capital-intensive bubble that's going to drag down margins without boosting the broader economy? Because if the economic growth isn't there, trying to justify a $5 trillion valuation for Alphabet becomes practically impossible.
And you can actually see this macroeconomic anxiety starting to bleed into the stock's momentum. The deceleration metrics are pretty glaring. The RSI, the Relative Strength Index, has cooled off from a wildly overextended 84.0 down to 70.24. Now, the bulls will tell you that's just a healthy recharge, but frankly, 70 is still technically overbought. The real red flag for short-term traders is the MACD histogram. We're seeing a rapid collapse here, from 4.79 down to just 0.39 in a matter of days. The upward price trend is still there, but the velocity, it's vanishing. The engine is sputtering, and mean reversion is fast becoming a mathematical probability. Speaking of mean reversion, we absolutely have to talk about the wall. The briefing defines this as the 200-day simple moving average, and right now it is sitting way down at $291.06. That is the absolute structural baseline, the floor. And the gap between the current parabolic price of $396 and that $291 floor is massive. It's dangerous. If the broader market suddenly goes risk-off, or if the sentiment around AI sours even a little bit, the gravitational pull down to that 291 level is going to be incredibly fierce. Which brings us to the immediate timeline and the ultimate volatility trigger. We saw the momentum cool on May 15th. Then, on May 18th, we got the confirmation of that massive institutional accumulation by Berkshire. And now, we are staring right down the barrel of May 19th, the Google I/O Developer Conference. This is the catalyst, folks. The market is expecting major ecosystem-wide AI pushes integrated natively right into Search, Chrome, and Android. If Alphabet can prove they can monetize agentic AI without cannibalizing their core ad revenue, this stock could easily rep higher. But if they underwhelm, that massive drop down to the structural floor becomes a very real threat. So how do the Vanguard portfolio managers actually synthesize all of this data? Here's their final calculated verdict. Overweight with a rating to hold and accumulate. They're actually recommending using this momentum consolidation to scale into a position. For the specific entry zones, they're looking at the 10 EMA at 390.69 and the volume-weighted support at 383.65. The upper target is sitting at the Bollinger Band around 425.15. But listen, risk management is absolutely crucial here. Because of the extreme volatility expected from Google I/O, they've widened the structural stop loss way down to the 50 SMA at 332.74 with an adjusted trailing stop around $370. You've got to give the asset room to breathe through the news cycle noise. Otherwise, you might get shaken out right before a generational leg up. Ultimately, the data paints a picture of a company locked in a high-stakes, capital-intensive war for the very future of the internet. They have the cash, for sure. They have the institutional backing of titans like Berkshire, but the velocity of the stock is cooling off right at the edge of a massive catalyst. It leaves us with a really provocative question. Will Alphabet's multi-billion-dollar infrastructure gambles successfully rebuild the roads of the internet? Or is this going to be remembered as the single most expensive defensive play in tech history? Vanguard Neural Intelligence. Refined.